Hi, and welcome to this edition of Financial Education Fridays. And this one is going to be about investor psychology and stages of the markets. Now, I apologize for not having put out on a regular basis over the last month or so, and every week a post like this, and that's for a couple of reasons. One, vacations. Two, I work so hard, I wore out my computer and I needed a new one, that type of stuff. But um, going forward here, this particular, uh, I had alluded to putting out a pretty important post, and or something that I thought would be very, very interesting. And as I thought more about it, I decided to make this sort of like a two-part uh, set of videos. What I was going to post, I'm actually going to post next week, but I think as I thought about it more, I thought it would be helpful to have a little bit of uh, 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 foundations, fundamentals, in order to be able to think about what I will talk about next week. So if you're watching this, pay attention to this, and then you'll see how it also applies next week. Okay. Um, but for right now, in this post, we're just going to talk about investor psychology and stages of the markets. Okay. Now, when I'm looking at this, I'm thinking about the stages of the markets. Just realize it doesn't matter what the market is. When it comes to markets, whether it's the stock market, commodities market, housing, buying homes, even things like antiques. Okay, there are stages in the markets, and of course, since people invest in the markets, they have a certain psychology. So that's kind of like the underlying way of thinking about certain things. And like I said, you'll see how it'll apply to something that I found pretty interesting, and I'll show it next week. But for right now, let's move on to the next slide here, and let's talk about the psychology of investors. All right. Now, markets go up and markets go down. Okay, and this here is I found this here chart. I don't know where it actually came from, but it's pretty representative of the investor psychology when it comes to the markets. Going from left to right, you see we have smart money here. Institutional investors get involved. This is where the public is. All right, and that's kind of like the you and me type of thing. But there, well, let's talk about the psychology first, and then I'll talk about the stages. Okay, so the smart money, they're getting in right at the very bottom of the market. Okay, now events happen, things get triggered, and this is whether it's a stock, whether you're buying IBM, Google, Facebook stock, you're investing in gold or silver, like I said, even in housing or even in antiques. Okay, um, the whole idea is, you kind of like want to be buying low and selling high, right? I mean, we've all heard of it, but a lot of people really don't understand what that means. The smart money, they know when to buy low. This is low compared to this is high up here. Okay, and they're accumulating whatever that it is in that market. Let's just keep this and let's just talk stocks. I mean, this could be antiques where I'm accumulating antiques. Okay, houses, I'm accumulating houses. I'm accumulating gold or silver. And as a matter of fact, I'm going to show you silver um, in the next slide to have a better understanding. But just realize that here, the smart money is they're buying and they're buying low. Now, institutional investors, they are the people who run the big funds, and they've got hundreds and hundreds of millions of dollars uh, that they have to be able to put into the markets, and therefore it's a little bit more difficult for them to be able to buy low because they have so much they have so much money to be able to buy. Okay, so when they look at something and they start putting their money in, the stock or the market begins to take off, right? And as you can see, it shows that there's a first sell-off. Okay, you realize that there and it's kind of difficult to explain, but the prices will go up and people will sit there and say, oh, I can't go any higher, I can't go any higher. And then there's a sell-off, and that's what they call a bear trap. Okay. Well, at this point in time, right, people are cautious. The general public is cautious. And remember, the smart money is already bought and they're still accumulating. The institutional investors, they're still pumping their money and they're buying and buying and buying, trying to get as much as they possibly can. But they want to get it at a better price, and they create a bear trap here where it sells off and are able to buy a little bit more, because now what happens is the media comes into play and you start seeing it on the news. One of the big things right now is 3D printing. Okay, I had posted, quite a few months ago about 3D printing when it was relatively unknown, and now all of a sudden I'm seeing more of it in the news, and there's even on PBS there was a TV show specifically just about 3D printing. So it's becoming more, the media puts out the attention, and the people, the public, the general public, all right, they catch wind of it, and oh, this is a good idea, this is a good idea, and so they get very enthusiastic and they're buying, 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 and they get to a point where, oh, now I'm into greed, I can go higher, it can go higher. I mean, if you looked at a chart of the stock market, I mean, right now it went up, it's at like, 17,000, right? And that's exactly right where the stock market is at. People are delusional because they think it can go higher, okay? But the institutional investors, and especially the smart money, they know they're at the top of the market. They know they're selling high, okay? So the public is all involved, and they're the ones who are buying, and it's time for the um, it's time for the smart money and the institutional investors to start unloading it so they can take their profit. And they can do that because there's the public there that's able to buy. Okay, so the public's buying what they're dumping, but there's so much, they've accumulated so much. Now it's time, for them to unload, because they know it isn't going to go any higher, and the price starts going down. Why? Because there's more supply than there is demand. Now the public, they run into denial. Okay, nah, this isn't it. It's just a bump in the road. It's gonna go higher because why? They're buying right here, and they think it's gonna keep on going up. Okay, but the fundamentals behind it show that it can't go any higher. Okay, those other forces, those other factors show it can't go any higher. So yeah, there's a bull trap where the market goes down and they prop it up. Now remember, the smart money and the institutional investors, they have to get rid of the shares. Okay, and it's not that easy for them to be able to just unload. So when they start, selling, the public is able to buy, and that's what this return to normal is. Okay, because they're thinking, you know, right here, their psychology is still the same. Okay, they're still greedy, they're still enthusiastic. It's returning to normal. This was just a pause in the market, when in reality, it's getting ready to sell off. Okay, and when it starts to sell off here, they become fearful, and as it goes down and further, they get this is capitulation, meaning they're in denial. Okay, they're panicking, um, and they bought up here. Let me change the color here. They bought here, and now they're here. Okay, and they don't want to lose any more money, so they're trying to sell their shares too. Well, what's happening? That price is dropping, dropping, dropping. Now they go into despair. Okay, and who's there to catch them? The smart money. Oh, the smart money is now sitting there saying, now is the time to buy, 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 so that they're buying those shares from the public, and they're able to get it down here at where they're buying low. And this cycle just goes, just a never-ending cycle. It goes up and down, up and down, up and down. Now, that's the psychology of an investor. As far as stages of the market is concerned, this part here, right, is called accumulation. Okay, this is when the smart money and the institutional investors are accumulating as many shares, and when they accumulate them all, the only thing that can happen is the price has to go up because people want to buy. It's just a law of supply and demand. So from here to here, Okay, this area right here is called the markup because the price is going up. When you hit the top here, and the smart money is now going to start selling their shares, they're going to distribution. They're going to distribute their shares. In other words, they're going to try to unload their shares and take their profit. And as the price goes down, all right, this is called the sell-off. Right? Those are the 4 stages of the market. And when it gets down to the bottom, now we're back into, again, the stage of accumulation. Okay? So, quick wrap up, quick summary here. Smart money gets in when it's low. Institutional investors have a lot of money and they have to buy, and that sort of drives the prices up a little bit. They also try to snatch up as many shares as they possibly can. The media catches wind of the price going up. Of course, if there's media, right, then the public sees it and they become enthusiastic and they start buying, and then they get greedy, and when they reach the top, they don't know to sell, and they're still holding on to it. And all the smart money at that point in time and the institutional investors know through fundamentals and other factors that, yeah, it can't go any higher, so they start looking to sell their shares. And when they do, you start having your sell-off. But it doesn't go straight down immediately. Um, uh, it has a tendency to return to the normal, makes the public think, we're still doing good. Now remember, the smart money wants to accumulate low. They don't want to accumulate high. Okay, so the price returns. People think, oh, everything is going along just fine, but then they start seeing it drop again, and they become fearful, and then they realize that they're in trouble. And if they still hold on to it, they're in despair because they've lost so much money, and then they can't take it anymore, and then they sell, and that's where the smart money is back into accumulation, where they're buying up the shares again, and the cycle just repeats itself. So let's take and look at a practical example of this. I'll go to the next slide here. Okay. Um, yeah, here's the previous chart from the previous slide, just as a reference. But this is the price of silver since 1968. Okay, now, and this is, as you can see on this chart, this says 2012, and yeah, obviously we're at 2014 right here. And as of today, silver is actually right here at 1550. Okay, that's the price of silver today. Um, so really, this is kind of like just gone down here, just a little bit more down to this level right here. Okay, so if we look at this chart, we look over here, and this is, I mean, I was 12 years old at this time, um, and this was accumulation. Okay, and as it started to go up, this was the institutional investors. Remember, the smart money has already been buying here. And we get into this area here where it's a sort of a sell-off, but basically it's still in that accumulation phase, right? Where the smart money is accumulating accumulating the ounces of silver. This is physical silver, okay? And then when they've accumulated enough, and they blame this on the Hunt brothers. If you do a little bit of looking, um, uh, they were trying to say that the Hunt brothers were trying to corner the market, and that's why the price was driven all the way up to the top. Okay, you do your own research. I'm not going to get into it here, but suffice to say that there's only a certain amount of silver that's available, and if it's all been accumulated and there's none to sell, the price is going to just, has to go up. Okay, and that is your markup phase. Now, during this period of time, you had the people, public, and the Hunt brothers in particular. They were, they were buying, buying, buying. It got to the top. Well, everything, that goes up must come down. And when you get to the top, that's distribution. Distribution. TION. And once it started to distribute, now it goes down and you have your sell-off. Okay, so here was the accumulation. Here was the markup. And yeah, the public and the Hunt brothers were buying, and they were getting greedy, you know, at $40 and $45. And I sort of remembered this back in 1979. Um, you know, watching it. I mean, I didn't own any silver at that time, didn't know anything about the markets. I wasn't educated. Okay, but I remember seeing it in the news, and it hit like 45, 47, and then it dropped. Okay, and when it dropped, what's happening to all these people that were buying here? Because let's face it, people can spend $45, and you know, as compared to gold spending $1,000, or at that time $700 or $800 on for an ounce of gold, they were buying the silver. And when the price dropped, you know, they became fearful, and they realized that they couldn't, you know, they were taking a loss, and they started selling, you know. And when they started selling, this is where the beginning of the smart money started accumulating again. Okay. Now, right here to here, the price bumped up. And remember, there's people that were still holding on to this. And what they're trying to do is they're trying to shake the people out of the market. They're trying to get them out of the market, trying to get them to sell their shares. So right here, they still had shares. They saw the price start going up. Their psychology was, it's starting to go up. I'm going to be able to get some of my money back. But then when the price dropped down again, they're shaking them out, and they can't stand it anymore. They're in despair down here. So they start selling because they, you know, they've lost so much money. I mean, the difference between, you know, even if you bought at 35 and now it's down to 10 or 5, you know, you lost $30 per ounce, and they can't take it anymore, so they start selling. And that's when the smart money, you know, begins accumulating again. Okay. Now, over the years, you know, all the smart money has been accumulating. And when we get over here to 2004, okay, notice what we're doing. We're starting the cycle back all over again. You know, here's you know, you're part of this awareness phase. You know, you're beginning as part of the markup here. Okay, you know, institutional investors are getting in right here. The public is buying in right here. And now we're talking, this is 2010. Okay, um, fortunately for me, all right, I look, you know, back here in 2006, I still didn't have any knowledge of this, you know, personally. I didn't know anything that I'm showing you here right now. However, if you watch my posts, you see me always saying, you know, buy silver, buy silver, buy silver. And the reason why is because if I look at this, this is markup right here, okay, and it got to the top, and so there was a distribution right here, right, and now it's going down again, okay, and that's part of the sell-off, right? And we're at 15 now. You know, you could say, well, back here, whoops, way back here, you know, silver was only like $4 a share. You know, $1, $2, $3, $4 a share between here and here. Okay, I mean, $4 an ounce. You know, we're at 15. You know, can it go a hell of a lot lower? Well, yeah. You know, I mean, I can even expect it to kind of like go all the way down here. You know, 10, 8. But if you understand the psychology of the market, you're getting into the point where all of these people, they're gonna shake them out, and the people can't stand their losses, and they're going to be selling, and the smart money is going to be buying. Okay, and they're going to be buying into this period of accumulation. Okay, where they're trying to suck up and control all of the as much silver as they possibly can. Now, if you look at this chart, you'd have a tendency to say, okay, Jim, let me change colors here. You know, if you look at this chart, you kind of like can say, okay, right here is kind of like where we are right here. And if you look at the dates, you know, we're talking what here? Let's just say 1980 to 2010. You know, that's 30 years. You know, if you're looking at it and saying, oh, I don't have 30 years to wait for this to happen again, I only have a couple of things to say about that. One, I mean, if you're 20 years old, okay, and you start accumulating silver. I mean, even at $15 or $10 an ounce, I mean, you can buy, you know, you know, one or two silver coins every single month, okay? And over the course of 30 years, you're going to accumulate an awful lot. And if you're buying it at 10 and it's going to go up to 40, okay, do the math for yourself, okay? See how much you can, just do the math yourself. I'm not going to work it all out here. But if I'm 20 years old, yeah, I'm going to go and I'm going to be trying to accumulate it, over the course of time. All right. It's almost a no-brainer. Silver is a used up commodity. I mean, they're not able to mine enough of it for how much we're using, so the supply gets lower and lower, and then from the mines, and also people are treating it as an investment vehicle. All right, and remember, silver is used in solar, pacemakers, electronics, so there's less and less of it, which means it's only going to become more and more valuable. And if you watch my other posts, you can go, you can see what I think about the prices of things. I think silver easily should be $150, all right, today, okay? Um, and I believe it's going to go higher than that in the future. But if I'm 20 years old, and if that takes 30 years, you're 50, you know? And if you've accumulated all of that time and the price goes from 10 to the 150, you'll never ever have to work the rest of your life. You'll be wealthy, period. And it's a simple plan. All you have to do is just persist and stick to the plan, okay? Now, what if you're not 20 years old? Okay. What if you're like me and you're 55? Okay. Well, 30 years puts you at 85. Okay. You start looking at it a lot differently. All right. However, um, it's not going to, I believe it's not going to be another 30 years. Remember, you're talking about economics and the government and printing of money and what's the store of value. The more money they print, I mean, right now, and if you've seen my posts, and it's not me just saying it, I back it up with articles and other people's opinions that due to our economic factors, they're driving, the price of silver should, like I said, should today be 150, but it's only down here at 15. you know, it's not going to take another 30 years for the price to continue to go up, right? If it takes, and I'm believing in we're talking at the most 10 years. I mean, from my perspective, but even if it's more than 10 years, okay, if it's 15 or 20, I'll be 75, right? And it'd be nice to be wealthy at that time. So, it's just a matter of your perspective. Now, if you say, well, what if I'm 70 years old and I'm watching this and I'm, thinking about this? Well, that's a little bit more of a different story because you don't have time on your side. Um, that I cannot, speculate as to what you should do because you are in your later years. I mean, if you do plan to live to be 90, well, then yeah, go for it. Okay. Remember, you're talking about comfort in the later years of your life. Okay. But here at the age of 55 or 60, you should still be doing, I believe you should still be doing that. And I'm doing it, I'm accumulating. Okay. I just had a conversation yesterday where it's time for me to buy more. And knowing that, even though that the price here today is 1550, okay, let me change colors here. Even though the price today is, come on, is 1550, right? And I realize that it could go down. I'm still going to be buying because I know that my return on investment is much greater than anything that I can get right now. Okay, so I hope that was helpful. I hope you understood that. If you have any questions or comments, post them. Um, you know, and create a discussion about this. Now, I had in the beginning of this video, which is now 24 minutes long, I had said pay attention to these fundamental concepts. I'm also going to show you something else next Friday, and that has to do with housing, okay? To give you some idea. And it interrelates with the silver. And the reason why I'm going to mention I'm showing silver and housing is because it's all part of my plan. So, um, watch this video again, but definitely pay attention to the video that'll be coming next week, and you'll see an extension of, remember this was fundamentals, but you'll see another example of how this works. Okay, leave comments, like it, and I'll see you next week.